And welcome everybody to another Smart Money Circle update. I'm Adam Sarhan. With me today is Chris McMahon, who's president and CEO of Aquinas Wealth Advisors. They do something very special, which they align your faith with your investments. I'm very excited for today's show. Without further ado, Chris, welcome to the show.
Adam, I'm so happy to be here. I've been a fan of the show for a long time, so I'm glad to be a part of it. Thanks for having me.
Oh, that's awesome. Thank you so much. So, Chris, I always like to begin. Can you tell us your story and how you got to where you are today?
Absolutely. So when I was getting out of college at Duquesne University in 1986. I was trying to figure out what was next for me, and the job market was tight, and I got a job working for Northwestern Mutual selling insurance. I remember those days vividly, and sometimes thankful that I've gotten beyond that. But so I started doing that in about 1986, and through the 90s did that pretty effectively, and over time started to develop deeper kind of relationships with our clients where they wanted comprehensive planning. And I started to build a team around myself and initially my practice, and over time to put together an organization. About 20 years ago, made the decision to become a registered investment advisory firm to provide a more robust process for our clients and our team. And here we are. This seems like we blinked. About 32 years later, we have two registered investment advisory firms, one of which, as you said, Adam, Aquinas Wealth Advisors, has developed in the last 5 years. What's happened is so many of our clients have said, boy, I'm concerned about kind of what my investments are supporting. You know, we used to just see that in the environment about 20 years ago, a little bit of that and a little bit of those kind of concerns. Now, we start to see it more and more where people are saying, I want to make sure my investments aren't supporting things that I really am opposed to. So we kind of jumped into that and developed some pretty neat technology that helps people align, do a really deep dive assessment of where they are in relation to their performance of their investments, as well as their alignment to their faith. We call it a faith and finance tool. It's an actual app that allows them, they can do it either themselves or with the help of somebody here, but allows them to take a deep dive into their investments from a performance perspective and from alignment with their faith. And then lets them kind of make some decisions going forward as how they want to, how consistent or inconsistent they want to be with their alignment with their investments and their faith. And that second company is developed kind of alongside of that separate investment advisory firm, developed alongside of MFA Wealth. And there's been certainly a lot of synergies there. But here we are 35 years later, and that's where we stand.
Nice. I love that. So, Chris, tell us a little about your investment strategy.
So we're traditional asset allocation folks, right? And it's developed slowly. Initially, when we first started years ago, we were just doing, using models, right, that somebody else provided. That was a bold step, right? Use the modeling that somebody else provided. But over time, as our registered investment advisory firm was developed and then grew, we started to really continue to embrace the whole concept of asset allocation, no question about it. So it's really a simple process for us. It starts and always starts and comes back to risk tolerance, right? That's something we spend a lot of time on. And I'm sure, Adam, I know you know this, there's been more and more tools out there to help people assess their risk level, their risk comfort level. When we first started, we just say, tell us what you are from a scale of 1 to 10. They'd say I'm a 7. We'd say, okay, let's put them in the 7, right? But now there's some just fantastic tools that are out there. Every day I'm more and more confused and excited to see all this technology that's out there. I have one of my brothers is in private equity, and they do a lot of stuff in fintech. And I'm mad because he knows more stuff that's going on than I do. And he'll say, "Have you seen this one?" So we've really spent a lot of time making sure that our risk assessment tools are correct, up to date, and we're constantly looking to make that better. And that's a big part of it. And then, of course, based on that risk assessment, we'll get into those allocations, which are pretty traditional. I see, again, you've seen these articles in the last 6 months or a year or so. Is the 60-40 allocation dead? I think about a year ago they said, oh, it's dead. And then I just saw an article yesterday saying maybe, not so fast. Maybe it's not dead. But I think, it's particularly with interest rates moving a little bit. I think the 60-40 allocation and the 70-30 allocation or what have you is alive and well. And so we're classic asset allocators. We use some portfolio optimization tools because invariably, Adam, we have about, I think the other day we said we have about 130 years of experience on our investment policy committee altogether. And I think a lot of that's hopefully good experience. But what we've seen is we'll build what we believe to be the perfect portfolio. We say this is exactly right. We feel like we got the secret sauce, and then we run it through one of these off-the-shelf optimization tools. And it says, nope, you got to tweak this, and by making those small tweaks, you keep the level, the potential downside the same, and you add potential upside. So it's a long answer to a question, Adam, but I think we are using traditional strategies wrapped around technology to make sure we're delivering an optimized portfolio that's consistent with a person's risk tolerance, which is critical.
No, I love that. So let's talk about it's a perfect segue for the next question. Talk to me a little about risk. How do you handle risk? What mistakes do you see people make with respect to risk management, et cetera, please?
I think about risk. This morning, I received an email from a client of ours a former client of ours, a friend, who this is the worst case scenario. A 39 or 40-year-old man had an opportunity at work where they were able to quantify some portion of the firm and sold a portion of their firm off. And he took his nest egg that he built. It took him 18, 20 years to build, about $1 million, and said, I believe crypto is the next great thing. It's absolutely the new world. And we were saying a little bit, hey, maybe we should just tread cautiously, do some of it, certainly. But this particular person put 100% of all of his assets in the crypto, which is very unusual, right? Normally, someone will take a more measured approach. Right. Very unusual. Yeah. And today, there's about an 80% loss. Now, it may come back over time, some of it, right? But that's obviously, highly speculative stuff, right? So the end result is that this risk assessment stuff is based, perfectly on the old adage, don't put all your eggs in one basket. And we do it in a couple of different ways. We're using some artificial intelligence for downside risk, mitigation. We use stop strategies, Adam, in our portfolios. A lot of our clients are more mature, and they're saying, look, I've spent my life building up this $1, $2, $3, $5 million, whatever, $20 million, whatever it is. And if we have a catastrophic downturn in the market, we just can't stomach that. We cannot look at our statement and see that we're down 41%. And then, we're always good in the industry, the financial services industry, is saying, well, it's not a loss until you take the money out. And it's been my experience that that's the dumbest thing in the world we could say to somebody.
It really is.
It's patronizing. It makes them mad. I feel it myself. I'm 58 years old. I feel it myself. I say, wait a second. We worked so hard to achieve this beachhead, and now to lose it and have somebody come back with kind of a glib little answer like that is wrong. I think a better strategy is to have some downside protection using, first of all, asset allocation, but that's not enough in a volatile market. And I think using some stop strategies. So if somebody says I have $2 million and the market's down 40%, obviously that even a balanced portfolio, let's say, was down 30%, that'd be a 600. Sorry, let me do the math, but it'd be a significant loss.
600 grand, yeah.
Yeah, 600 grand. So my 2 million is $1.4 million. I'd rather say we'd rather say to our clients, your $2 million is $1.7 million because some of your stops hit. Look at the difference. Look at that beta. Look at that delta that you were able to preserve. And I've heard a lot of questions. Well, how do you know when to get back in? And so that's the argument I think sometimes used against stop strategy. How do you know when to get back in? And if you look at a lot of these long view charts, it obviously pays to stay in. However, that doesn't matter to the person who's saying I have $1.4 million in my account. And we say, well, stay the course, in 4 years, it'll come back. That's true. But we've seen other people say, I'd rather say I have 1.7 or 1.8 million and I have a little bit more control, because that lack of control we've seen really drives people crazy. And certainly that's not all of their assets, but it gives them some protection, knowing that in the worst case scenario, I'm not just simply doing nothing. That's something we see, Adam. People don't want, it's been our experience, people don't want to see inaction. Not that we're always taking action, we're not doing action for action's sake, but without a plan, without a conversation, I think at some point, much like the conversation we said a moment ago, where people will say, oh, it's a paper loss, so you need the money, right? It's the same thing saying, stay the course, absolutely don't do that. That's a bad idea. And we become professional naysayers, which I think is, sometimes at some point wears on our clients for sure.
Yeah, I agree with everything you're saying. I'm a big fan of stops also. So do you use stops from entry to exit, or do you use it on a portfolio basis, meaning it's at 2 million, you don't want to drop below 1.8 or 1.7 or whatever arbitrary number you pick?
Yeah,
Or
I think I think what we normally do is we'll set them across our portfolios, and we'll set them based on the most recent purchase price, maybe 12, 13% below, because there's a lot of volatility in between that 12 and 13% range, so the stops won't hit. But
yeah,
I think a lot of times when people say, my goodness, the market went down 45% and you guys didn't protect me in any way. And I think
yeah,
it's a much more reasonable thing to say, no, we made some protections. And then I think it's also reasonable too, Adam, to say to folks, in good times, hey, we have these stops, and let's run some simulations of what would happen if the market goes down. And if the market goes down 40%, these stops would hit as it sits today, and look where you'd be. And I think people say, well, I understand the plan, and we discussed it, and I have comfort. And the other thing we did in our firm about 2 years ago is we shortened our bond duration. It was that simple. We said to ourselves, we're not this, we don't, I don't think it's reasonable to espouse that we're the most, we have inside information, or we have information no one else does, or we have the smartest guys in the room.
yeah,
There was a wealth management firm in my building that used to say this. I ran into 5 or 6 or 7 people around town who would say, that guy's a genius. And I would say, wow, who told you that? And they would invariably say his father did when I got to the bottom of it.
that guy, right? Exactly.
Yeah, exactly. So I think we don't want to do that, but we want to say
Right.
we have defendable positions, we have reasonable, and we're very transparent. Here's what we're thinking. We make our investment policy committee notes to our clients if they want to see them. We don't do it we don't want to talk about secret sauce. We want to talk about applying reasonable strategies, time-tested, true strategies, and applying them, with discipline. And really building a portfolio for the long term. And that's what happened with the bond duration. We said, my goodness, let's shorten the bond durations. And when we looked at it last year, just that simple technique of going to from a 7-year maturation to about 1.5 years, which was easy when you have ETFs, right? It's not a difficult thing to do, or in automated trading. So anyway, the end result was, I think we say, anybody who shortened their bond durations would save their clients probably 2 or 3% on the downside, just simply by using that technique.
No, very, very well done. So question, are you more of a fundamental, you said asset allocation, but are you more of a fundamental based investor, bottoms up, or more technical with charts top down, or some combination?
I'd say some combination. I think that's it, because I think there's we certainly use a lot of third-party data, a lot of third-party analytics to help us build our portfolios. And then we do some, at the end of every of our meetings, we just do kind of some let's turn the computers off and just talk in general. What do we think is going on in the world? Where do we think the next cool thing is, right? We just had a long conversation about, the new diabetes drug that's going to help offset obesity. Will that be the number 1 drug in the history of the world? We don't know, right? But it's a little bit of both, but not everything we have and we share with our clients is based on, we need to have some data to back it up, right? We need to have some third-party endorsements beyond them, beyond Aquinas Wealth Advisors, to say, here's what we think, here's what others think, and then also getting back that concept of properly allocated portfolios. We're not going to. Our firm has never said we're all in on X. We're never all in, right? It doesn't pay to be all in.
Exactly, because the crypto example you just gave, because when things don't go right, bam, you get crushed, and then you can't recover. Yeah. Okay. I love that. So let's talk, shift gears for a second here, Chris, and talk about some timeless lessons you've learned along the way. I mean, you manage over 500 million now. Obviously, it's a great feat. What are some timeless lessons you've learned, both professionally and personally, that you'd like to share with the audience?
I think the one that I've really learned the most, and it's taken me a long time to do this, right? And they say this, I was not a good athlete, right? I was not a good athlete, but in baseball, they always say, don't swing at the first pitch, right? That's always a classic line. In my entire life, I swung at the first pitch. When someone came at me, client, prospect, anyone in the community, and said, I don't like the stock market, and here's why. I don't like using financial advisors, and here's why. Or I don't like you personally, and here's why. Right? Any of those kind of things, we would, we'd immediately respond and come back. And I was looking on my desk to show you, and we'd come back with reams and reams of paper or handouts and say, here's why that is. Let me refute this in the most logical, sensible way. And let me refer to page 83 of my handout refuting what you just said. And I realized the reason they say, swing at the first pitch is because it's disinformation, right? Yeah. It's not the real, what's in somebody's heart, what they're really thinking about. And I think if I could have go back and say, Chris, 25-year-old Chris, stop doing that. You're going to waste an enormous amount of time. And also, you're gonna, when you lead, you have to lead with maturity, and you have to lead with calm, I think, and a vote and eyes on the horizon a little bit more. I think sometimes we have a tendency to get worked up, which we need to do a better job of ourselves running firms, investment advisory firms,
Right.
or any kind of business, frankly. And we get worked up, and then we communicate that people down the line, which is unfair because they don't have the same ability to pass that on to someone else, right? And also, they might be running in circles doing enormous amounts of work for something that again was the first pitch, and they'll say, well, that's not what I meant. A few weeks ago I went into a meeting and someone had requested just a lot of information, years and years of analytics. And even though we use a lot of portfolio performance software, which makes some of it easy, when I saw this request, I said, my goodness, there's a lot requested here. What is going on? Unusual. And the folks came in. I said, let's not do the work yet. Let's understand what what they're really asking. They prepared a few things, but as I sat there, I said, what are you guys worried about? What's going on? What are you thinking about? And they said, well, he's sick. The husband was sick, right? And I don't know, God willing, he's going to be okay, but it's real. It's real. The sickness is real. So what happened was, in his mind, to take control of his financial life, he thought he would ask for 4,000 things to say, we got to go through these things because I have to check, retrospectively everything that's happened to make sure I'm okay. And that wasn't it at all. The conversation was around, you're okay going forward, and here's why, and here's how we work, and reminding us of the values that we share. So, and Adam, that would be something I would really encourage too, that to make sure we have values aligned with the people we serve in the financial services industry, in any business, but in financial services particularly. I made the mistake too of working with folks that I probably wasn't in alignment with, and I thought I was fine. They're just different. It's fine. We have different goals and we have different objectives, but it doesn't matter. They have this particular need, and it reminds me of a story I thought that was somewhat horrifying. A few years ago, someone had called us and asked it to help their client with their investments, which happens often now, thankfully. And our folks, I talked to the person personally, and our folks talked to them, and we did like we always do. We said, well, absolutely, we'd love to work with you. It made sense. And we took them into our firm. And a few weeks later, one of the custodians, in our industry, we have custodians.
Right.
One of the custodians called. It's the only time my career this has happened. Said, we cannot open this account. We have our own diligence that we do. And I said, okay, I've never heard of that. You're just a custodian. Why would that be? And they said, and I never forget, they said, this particular person is currently being charged with treason. I said,
wow.
Pardon me? Treason.
Oh my goodness.
Thought, treason. My Lord. I've never heard of that. I'm uncomfortable even saying it now. It makes me so nervous and sad. Just like, oh my gosh, thank you for telling me. And I called the person who had originally introduced us. Excuse me. And I realized the person who introduced us and I were not in alignment.
Okay.
And I said, I need you to understand this person is being charged with treason. And he said, oh, I knew about that, but I didn't think that should be part of this conversation.
Oh my goodness.
And I said, now, someone who's in alignment with us would never, ever, ever do that, right? And so it's a shame on us. So I would say, make sure we're in alignment with folks and don't swing at the first pitch. I hope that answers the question,
Yeah, that reminds me of Back to the Future, McFly, anybody home? You should do that to your friend, whoever that guy was who introduced you.
Yeah, absolutely.
Yeah, seriously.
Yeah, it's a Biff, right? I agree.
Exactly, 100%. All right. Yeah, I love that. So mistakes. What are some timeless mistakes you've seen people make, and how do you avoid them?
I think the mistake that I've made and I've seen people make, I'm trying to, we have 5 children. I think some of them are making some noise maybe about joining the industry. And I said, what are the mistakes we make? One is that we waste time, right? That we work inefficiently, that we don't just do this. Any industry, any job is, it's the people who stick to the little rituals that they're successful. Find those little rituals and just do that. 100%. Forget about everything else, right?
Yeah.
It's number one, right? Stick to the rituals, number one, and find people that'll do that. And I think also just to be calm and know things take time. And the mistakes I see people make are trying to, circumvent that process and say, I'm gonna just get to the end. I know it takes years and years and years, but I'm going to try to skip ahead to the end. And if I skip ahead, then I should be fine, right? And it never works out that way. Or if I do X or Y as opposed to, creating relationships for the long term. But if I somehow try to avoid that pain, avoiding the pain is bad. And we need people to say, I understand it's a painful walk. I'm going to take it. And I know 3 years from now, when I come back, when I'm at the end of this, or at the end of let's say when I'm at the end of the beginning of that, that I feel that I'll be better for it. And it'll help me grow. So embrace the grind, I think, is the mistake. People, they don't do that. They don't embrace the grind. And,
I love that. Yeah. So Chris, we just met. I mean, this is our first time speaking, and I wrote a book. It's called Psychological Analysis. It was #1 on Amazon. And the idea is that fundamental and technical analysis are not enough to beat the market, in my humble opinion. If they were, everybody would own a few islands in the Caribbean. So there's a missing link, which is that psychology, which is know thyself and master thyself, and also understand the psychology of the crowd. It's amazing to me as I hear you speak. So many of the things that you're saying, the stops, I got stops in the book, the style drift, avoid, jumping from different styles, or even making sure you do the small rituals. There's a great book called The Slight Edge, which talks about just do that little thing extra every single day. Over time, it's cumulative, right? And the compounding effect is just next level. I love what you're saying here. This is really, really fantastic. Okay, wonderful. So I guess, what's the best piece of advice you'd like to share with the audience, or you'd like to give your 30-year-old self?
That's it. I think about that a lot. What's the best piece of advice? I would say the best piece of advice is be a better father and husband first, right? If you have, be a better man outside of your professional career. I think I made a mistake of thinking, going all in, thinking this is what everything is supposed to be. Then the ancillary things will follow, right? That'll all take care of itself. I'm going to spend all my mental energy working on building this firm, building my professional reputation. And then, here I am 30 or 28 years later, 30 years later, 35 years later, saying what a fool I was, because had I, all these moments, you blink and the people around you are grown up and they live in New York, right? And then, my wife and I are very close, but I would think, of course we are, but I think I regret the lack of attention I paid. Even though I was there and doing stuff, I didn't embrace for what it was. That we work to spend time with our families, to impact our communities in a positive way. We don't work, without regard to those other things and let those fill in the gap. But I think that's a regret I have, that I made the mistake of taking that for granted. And now, as it's kind of not slipped through my fingers yet, because I still got a good grip on it. But I think to myself, I'm so blessed now. Why didn't I remember when I was 32 to really just, and I was happy, but why wasn't I more just fully engaged with the same level of passion to my family, which is by far the most important thing to me.
100%.
Why wasn't I thinking of that, giving it the same conscious effort that I was giving my business? That would be the thing I'd tell myself to do. If you give me a do-over, that's what I would do,
I love that. It's like slow down and smell the roses, like enjoy the journey. Yeah.
Absolutely.
So powerful. So my kids are still young, Chris. I'll tell you a funny story. There's a new movie called Puss in Boots. It's what Shrek. It was a spinoff of one of the characters. And the latest one, I just took my 6-year-old to the movies to go watch it. And there's 3 main characters. I'm not going to spoil the movie for anybody because I know it's a huge cliffhanger. But anyway, one of the characters, he's this carefree, kind of lovable character. And they have this wishing star where each one of the characters you have to go through a dark forest to get to this star, and then you can grant your special wish, right? And at the end of it, it says the wish is you don't need any magic, just enjoy life. But each one of the journeys of the 3 different characters, one was dark, one was a little bit in the middle, and the one that was the most lovable and really speaks to your point here was a total carefree, lovable kind of journey to get to the wishing star. And the first stop was the field of posies, like ring around the posy, pocket full of posy. So the 2 characters that were still not, that were intense, they were trying to fight the flowers, slash it, cut it down. And every time it would grow back again and eat them, kind of a thing. And then it'd grow back and eat them. But the carefree, lovable character went over there and just smelled the roses. And then all of a sudden it cleared the path and they could walk through it. It was like, boom. It was
it.
such a powerful, message. So
That's
powerful.
right on. That's right
Yeah.
on. That's exactly what you're talking about for sure.
Yeah, I love it. Well, Chris, thank you so much for coming on the show. What is the best way for people to get in touch with you?
I think if we looked at our website, which is www.aquinaswealth.com, aquinaswealth.com, and they could learn about some of these strategies we're applying to align them with their performance and their faith. I would love to. I'm available there, and our whole team is. So it'd be great.
Love it. Well, Chris, thank you so much. Hopefully, we'll have you on again soon.
Thank you. Have a great day. Good talk. Great talking to you. Bye-bye.